Excellent. Well, good afternoon, everybody. I hope you're enjoying the day. You find some value in the conversations you've been having. Welcome to our panelist discussion on working capital for startups and emerging businesses. I have Mr. Mustafa Nasseh and Matt Stavish. I will let you guys kind of give a quick introduction about who you are, what you do.
Yeah, good afternoon, everyone. Pleasure to be here. My name is Mustafa Nasseh. I'm an executive director with JPMorgan Chase Business Banking, focused on small to medium-sized businesses. We have a lot of conversations with a lot of our startup folks and business owners. So I look forward to this conversation.
Matt Stavish, with Public Capital Access. We're a specialty non-bank finance company for government contractors. Been around since 2009. We financed about 1,200 companies since our inception. I've been doing this for 10 years. We work with a range of companies from startup, we'll fund the first payroll, all the way up to companies that are publicly traded, kind of running the gamut, but all in the working capital cycle for government contractors.
Great. Well, thank you guys both for being here. And so, we just had a panel that was kind of from the business owner perspective, right? In the other room, but what we'd like to do is give you some of the perspective from the lender. So absolutely, if you have questions, feel free to ask away. But I guess, guys, the burning question is, why do I need funding at all?
I'll jump in with that one. So when you're getting funding as a business owner, you're trying to all solve a timing problem. That's generally the problem that we solve. Like, we don't sell money, we sell time. And you need to get access to capital based on your collateral to make a payroll or pay a supplier. So generally, when we get into conversations, it's to fund a timing problem. Sean Drake mentioned it earlier in his session that revenue solves a lot of problems. So when you start executing on a contract, at that point that you start executing, as you start charting out your cash flows, you will then develop the timing problem, and that timing problem will lead to, how do I finance that time?
Mustafa, is that kind of the same thing from the banking standpoint? Why might a business need to come to a bank for financing?
Yeah, no, I think Matt covered it very well. At the end of the day, regardless of the type of business you have, the business life cycle, changes as you start. You need some capital to get started. There are different sources of funding, and we're going to talk a little bit about different sources and what's most accessible for a startup versus a established company. But a lot of times, I think this was shared in the other room by Sharon as well. Is you may have a phenomenal product, you may have a fantastic idea. So it is not that's the reason that you are not successful. A lot of times it's the cash flow, the challenges that come with managing cash flow that causes a business to not grow or to, God forbid, not exist in 12 months. So I think for that reason, you want to make sure that you have different sources of capital available to you and kind of use, to the extent possible, other people's money to grow your business instead of investing all of your own assets to get started. So yeah, look forward to talking about it a little bit more.
So what are different types of funding that are available to me? I mean, do I need a line of credit? Do I need a loan? What kind of different kinds of funding are available?
So there's a lot of funding that's available. One of the challenges in the finance market is the nomenclature of the finance market. So you're going to see people just, like, we'll have someone say, I need mobilization funding, okay? I need payroll funding, or I need receivables funding, or I need a line of credit. And people throw around a bunch of terms, and a lot of them are always the same thing, right? And so as you're starting a company, if you don't have a finance background, and you don't need to have a finance background to start a company, obviously, getting a handle on the nomenclature of what people refer things to and what they actually are is a good place to start. And if you don't know what a word means, ask people, what does that mean? Generally, the easiest place to start is, or for the type of product out there is, what is it that you do And then how do you go from start of a contract received to generate a receivable? So simple example, services firm, you need to make 2 payrolls to get the first receivable, right, if you're bi-monthly. The product firms, you need to buy something from someone that then goes to the end user. That'd be the reseller, right? And depending on a couple different things, you may need a type of funding called purchase order funding, right? Generally, that's a good place to start, but it just comes back to how do I go from I have a contract to generate a receivable, and depending on what you are, will dictate the type of funding to fill that gap.
Yeah, I'll just add to that. I think if you kind of take a step back and talk specifically about types of funding available, right? Equity versus, loans that you'll take, right? So there are 2 ways that you can raise funds. You go to a bank, submit an application for a credit, whether it's a line of credit, a loan, that you need to secure some funds to continue to grow your business or, bridge the gap. Or going to private investors, angel investors, when you're really a startup early on, and maybe your family, maybe your friends, we call it seed money, right? So maybe small amounts of money. Virtual VC is part of it. Private equity is another part of it. So there are different types of funding. You're gonna have to find out, what is it that you're looking to accomplish, and then who are the best providers of funding for those types of situations. I think it was mentioned a few times by Sharon in the other conversation we had earlier, that banks want to make sure that you are making money, right? You have a product that you're selling or your service that you're providing, and that in turn brings you in some money, so you're able to pay your bills. You have to make the case for that. There are a lot of banks, including JPMorgan, but we're going to talk generally today, not specific to our underwriting or types of appetite that we will have, but in general, when you go to a bank, they want to know, what the story is. Why are you getting involved with the business that you are? There are different sources of funding, including SBA, which we'll talk about a little bit more. Different sources of funding, and that's what I would say to that. Yeah.
What about timing, though? So, I've just been awarded a contract. Am I ready to come in and talk to you, Matt, or am I ready to come in and talk to a banker?
So for us, if you've been awarded a contract, there's a high likelihood that we can probably help you fund working capital on that contract. We're not a bank, so we move a little bit quicker, and we don't have the regulations that a bank would have. So if someone has a contract in hand, we can probably help them get going. What I would tell folks is, so it's a high likelihood you can get funded if you got like a subcontract to Booz Allen or to the government, certainly help with that. The challenge, what will happen is you'll spend a lot of time searching for maybe to get a bank line of credit, and for a lot of reasons that Mustafa can get into, that may not always be possible just because you're too early or not enough operating history, all those things that he'll get into. And so you kind of need to run a parallel path if you have that first contract, or like I may have a contract that may start on this date. Getting ahead of the curve will reduce stress, not only for you, but also for whoever's providing you capital. So have those conversations as early as possible. We have conversations with folks 6 months before they even start a contract, just to get ahead of that curve. It's a high likelihood we can fund, but timing does become an issue.
We work, we have a great partnership going on with Matt and other firms as well. Different banks and different firms partner in those situations to make those introductions to the right folks that are able and willing to provide you that capital. But when it comes to, from a banker's perspective, right? So you're a businessman, you have a company, right? But at the beginning stages, it's like you are the businessman. It's all you, right? We are depending on you as the business owner, your vision, your plan, your projections as to how you're going to go to the market, right? So depending on the amount of money and the funding that you need, there are some cases that you can get a small line of credit to get you started. But if it is your very first contract that you have won and you need a significant amount of funding, and you can define significant versus small amount, and we can talk about that separately. But those are situations that perhaps Republic Capital would be an opportunity to look at your invoices or look at your contracts that you have won and get you started, and then eventually graduate you to a line of credit that the bank might be able to offer.
So would my would my banker, would I be better served, if my banker is kind of offering advice versus kind of, saying that I don't qualify? Like, what is it that a banker can do to kind of help somebody who's getting their business off the ground to kind of give them a better sense of what the next 12 months, 24 months look like from a financing standpoint?
Yeah, so I'll jump in. I think one of our panelists, again, I keep mentioning the previous conversation. I hope you were part of it, or at least in the audience there. One of the panelists there, Ms. Dobbs, I believe her last name, mentioned this, right? Having a bank and a banker that is truly an advisor and a partner, part of that three-legged stool. You have your lawyer, you have your accountant, and having a good banker is extremely, extremely important for you to get started your business, or even if you have an established business, because providing you the capital itself through a line of credit or loan is one way that they can help. But more than that, the advice, the expertise that they can bring, the connections, the resourcefulness that they bring to the table is what can get you much, much further as well and faster. Because you don't want to spin your wheels, going to 15 different banks applying for the same thing. If you know exactly how you should go about it and you have a banker that can help guide you through that process, I think you will be ahead of the game compared to others.
We recommend folks always start with their bank, because in most times out of 10, you may use us for a period of time, but then you'll graduate to the bank line of credit. If a bank can't provide a fit, all the bankers that we know, they'll refer you to a better fit than them. And that's a lot better than going on the internet to try and find your funding sources, which we see at times. So plus you need a treasury account somewhere. And so it's good to have a treasury account with someone that knows your market.
Yes.
This thing makes it more difficult for me to talk, actually. So you talk about connections. I mean, I think we all know that relationships are king in the government sector. It's almost what makes doing business in the government sector fun. Imagine that you all provide relationships and connections as part of that broader ecosystem to support businesses throughout their life journey. My question is, related to the group that we have here up on the stage, Matt, as you work and provide your ecosystem, your relationships, your connections to help small businesses grow, maybe get off the ground to some degree, to what degree do you extend those connections, share those relationships and connections with the others on the stage to support kind of a continuous journey, if that makes sense?
I mean, two quick examples. I had a client that called me up last week and he's like, oh, I'm going to start this other company with my son. And, we're going to be an 8A, we're going to do this. And I said, stop. You already have a company that you're 100% owner of. I was like, I'm not an attorney, but I'm pretty sure you have to structure this in a much different way than you're thinking about. So I said, why don't you speak to this guy over here? He's a GovCon attorney. He can probably answer this question for you in about 15 minutes. But we're working on a deal right now that we'll end up closing that Will at JP sent over to us. And they're actually working with your wealth group too. And we'll provide them working capital probably for about 18 months. And then they'll probably, go to the bank. So there's a lot of kind of those back and forth or synergies, if you will, to kind of, do what's right, if you will, in the ecosystem. So I mean, I say that's kind of the nature of the business.
Yeah, no, absolutely. I'll add to that, and thank you for that question, because it reminds me of a disclosure I had to provide everyone. So the opinions that I'm sharing here today are all mine and not that of the JPMorgan Chase, of course. With that being said, and getting that out of the way, and should have done that early on, I think, one of the things, being a very heavily regulated industry, right, the banking world, and especially when you're the largest in the industry, it comes with its additional, things that you have to be careful about. So when we make those introductions, we will never, mention one person or one name or one contact. You will always have a number of folks, at least 3 that we will share from different industries, right? Whether it's related to capital access or access to capital, whether it's an accounting firm or a law firm that we will make that introduction. We host and also sponsor a lot of events like this, where we will provide the platform for the industry folks to come in, mingle, get to know each other and network. So we do a lot of that. We have a huge one coming up here in May in DC by Union Station. So, look for some additional information on that on LinkedIn pretty soon. But with that being said, I think what's important for you as a business owner is to know who to go to for advice, right? Whether it's a banker, whether it's an attorney or an accountant. You might go to a very capable accounting firm, but if they don't have expertise in the government contracting space, they may not be able to really help you other than doing the basic accounting activities for you. So I think with that in mind, it's important to know who you go to for advice and who has the resources to make those connections for you.
Yeah, I mean, that's a great point. So we tend to work with professionals and service providers that are in the industry and specifically work with GovCon because we know that there's definitely some things around GovCon that are very different from, say, manufacturing or some other industry. So what are some of the unique challenges that GovCon has that, especially in the emerging space, and how can we kind of address that with the product suite that you guys have available?
So who's read the FAR? Super exciting. It's a good bedtime story, read to the kids, right? So the biggest distinction as a startup or anyone in the government space is you have the FAR, right? Which obviously is a legal document that is used to procure goods and services, right? So there's things in the FAR that, like, for example, FAR 9.104. Anyone know what that one is? Do you have financial capability to perform on your contract? We give letters of financial capability all the time. I know that, the bank does too, because contracts will have FAR.9104 and FAR 9.104B. Those are the financial capability clauses, right? So especially if you're going after sole source, if you have like an 8A designation, that'll be in there. I gave a letter of financial capability yesterday for $15 million. Happens all the time. But your client asks specifically at times, the government, your client asks specifically for that. In the non-bank space, FAR 32 relates to an assignment of claims if a third party is in control of funds. We follow our company follows that FAR clause. So I think that the biggest distinction is you have this really gigantic legal document, and that changes to your point on accounting metrics, like cost plus contracts, right? How things are accounted for, what that means. Like, you shouldn't be explaining that to your accountant, right? But the FAR dictates how those certain things should be done. I think that's the biggest distinguishing factor.
Yeah, no, I think I would agree with that 100%. And to bring it back on it, not talking too many technical terms. By the way, GovCon industry, I think is the only one that has more acronyms than the banking world and financial world. So you got to have your dictionary out all the time to understand what the three letter acronyms are for. With that being said, I think, a lot of times we have clients who, are dealing with a cash flow situation, right? They have a contract or two. All of a sudden they're awarded another large contract, which, requires them to hire more folks. They may have that gap, where, they're waiting to collect on their receivables. They have some capital, but that's just for the payroll for the existing staff that they have. So how are they going to do that, right? So I think that's one of the challenges that we see in the GovCon industry. And so to be able to have, a relationship, have that track record, be able to have a banker who understands, what that looks like, what that life cycle looks like, I think will, again, help you in that process of accessing more capital. And, we're talking about oftentimes with our clients about bidding lines of credit, right? They establish a line of credit, they will never need it, but they need to have it to meet those clauses that Matt was talking about. Like, do you have the capability to scale and grow and, if needed, hire more folks? And that's one way to show it that, hey, I have the backing of a financial institution or another financial firm that if needed, I can tap onto and access that capital.
Great. So I kind of want to give some of the attendees maybe a sense of the process that you go through when meeting with a client. So Matt, what does that look like for a company that's kind of getting started? What kind of terms, structure, to their facility do you put in place? What does that process look like?
Sure. So we're pretty simple as far as what we do. We try to always get a gauge first of like where's the cash flow pain points. You can grow really quickly and without proper cash flow be very frustrated and be very stressful. So we try to figure out where those pain points are. When constructing a capital solution for someone, we are really big believers in you want a revolving financing facility. And what I mean by that is, if you have $100 of a receivable, you can borrow that, and then when it gets paid down. We like that revolving nature of the facility. That reduces the risk to the business, and it gets you ready to go to a traditional facility, because traditional banks are going to want to see your line of credit revolve up and revolve down. That's a good thing to do. We do not like using term loans. It's the financing of last resort. The quickest way you can go out of business is generally to get a term loan and then miss payments on that. So typically it's determining if you get a contract and you're working on it, what do you need to get to a receivable, and then going from a receivable to payment, and then what's that gap in timing look like? And in GovCon, that's typically a 60 to 75 day window. That's your operating cycle, right? And the pre-receivable side is the unbilled, and the post-receivable side is the billed. But getting a handle on that 60 to 75 day operating cycle, right? If you're in the product space, there's a couple of nuances which we handle. Most folks are services in this area. So it's really getting a handle on the payrolls. Scott Semple mentioned something earlier, which we see to be a lion's share of the opportunity when people are starting out. They're usually subs and sub to a large integrator because they have the most seats, right? So does that make a lot of sense? Like, go get 10 seats from one person instead of 2 seats from 5. Makes a lot of sense. So it's really getting a nature on that cash flow. And then we'll put in a revolving facility. If they need unbilled financing, we can put that in. If they need a billed receivable, we'll put that in place. It's something then that revolves up and down on the needs of the company.
Yeah, the only thing I guess it's appropriate for me to talk a little bit about the sources and uses the way we see it from a banker's perspective, right? Where's the money coming from? What kind of money do you need? And how are you going to use it, right? So there's short-term needs that you have to pay for, which, a revolving line of credit, even a credit card, and oftentimes can pay for those things. But then you have longer-term investments that you have to make to grow your company, whether it's, building out office space where your employees can operate from, in certain cases that is needed. In other cases, you're on the client side, you need to buy vehicles, whatever it may be. You may need the technology infrastructure. And if it's a CapEx or capital expenditure, long term, you're not going to get the return on it. It doesn't generate accounts receivable for you. It's not a contract that you're performing on. Those are scenarios where you will need a term loan because the repayment of a term loan would be over multiple years, more than 12 months. Long-term investments require a term loan. Short-term, generally within 12 months and 90% of the time in the government contracting space, you're going to need a line of credit. You're going to need a revolving line of credit, and the purpose for that is to, again, bridge that gap between payables and receivables. That's the primary purpose that it should serve, and not be one that you use it for long-term expenses, because what that does is basically now you have capital, you have maximized on the line of credit. All of a sudden you need additional true working capital, and now you don't have the ability to tap into that line of credit again. So for that reason, you want to separate the two, right? Long-term versus short-term. The other thing that I should talk about a little bit is where we think we can help a lot of our clients is also providing them different ways of collecting funds, whether it's from government agencies or others, but also making payments, right? So if you can delay your payables by a couple days and expedite the collection of your receivables for a couple days, a lot of times you eliminate the need for having a credit vehicle, a line of credit or a credit card, right? Credit cards typically for small businesses, if you can pay your vendors for a credit card other than payroll, generally you can pay for a lot of things with a credit card. It's interest-free for 45 days, right? You have a full month and then you have another 20 days to pay that back. So that's a good short-term, small amount solution for startups, right? We're talking about really small businesses, startups, right? In other cases, having treasury management, cash management products, an online platform that enables you to make those payments or collect payments, even including with a credit card. Government has a lot of agencies that pays with credit cards. They have the capability of accepting that. So if you can expedite that versus waiting for a check or wire is another way to do that. Different ways to do that, but again, the goal is there to delay your payables, expedite your receivables, and delay payables by not defaulting, of course, using the right means, using a credit card, using a line of credit, and you can improve your cash flow doing just that.
Well, let's talk a little bit about things like personal guarantees, right? We know that for a bank credit,
Yeah.
the owner is the business, right? In many cases, especially in our group. So what does the risk profile look like, Matt, in terms of the capital that you provide versus something like what a bank might put together?
So our standard product, we don't do personal guarantees. We do that for a structural perspective. When we finance the receivable, we want to own it. That lowers our cost, and so we can pass on those cost savings, but we don't have a personal guarantee in our standard financing. We do have like a minimum threshold. It's exceedingly easy to hit, and we don't like to see bankruptcies. That's never good for anybody. But we don't have a personal guarantee in our standard financing.
Yeah, and in our case, or in our space for small to medium-sized businesses, and so I've been in the industry, in banking world, for about 18 years now. I've had the opportunity of working with a few different large banks, including names like Wells Fargo, now of course Chase, PNC Bank in the past. So across the board, any bank that I have been a part of for small to medium-sized businesses, generally from startup to about 20 million in revenue, you're going to have to stand behind your business by providing that personal guarantee to a bank, right? For banks, it's very simple, right? It is your company, absolutely, and we want to make sure that you are standing behind it, right? We will provide you the capital, especially if you're in the first 2-3 years of your business operations, right? But as your business grows, most banks have different channels within the bank. We have middle market corporate banking that you can grow into that, and in those cases, your company can stand on its own without your personal guarantee. But at the end of the day, again, as I mentioned earlier, we are dependent on you. We rely on you as you build your company. So basically, 100% of the time, you're going to need to provide personal guarantee. And for the way it works is, because people mix that sometimes, and I think it's important to provide that clarification. By a personal guarantee, we don't mean that we are going to put any liens on your personal assets. So banks don't go and put any liens on your personal assets or take personal accounts as collateral. It's merely a guarantee where if for God forbid, your business is unable to pay the monthly dues related to that line of credit or that loan, then you're saying that I will personally be able to pay it and will be willing to do so, right? We will have collateral as a secondary source of repayment. But primary source of repayment for all bank loans is cash flow, right? Cash flow generated from the operations of the business. You have a product, a service that you provide, you receive some returns. Hopefully there's profitability, and that profitability is used to make the monthly payments and keep you going. So as long as that happens, your personal guarantee never comes into place. We don't necessarily actually report the line of credit onto your personal credit report. So it doesn't affect your ability to borrow personally, whether you're going for a mortgage or credit card or a car loan. It doesn't affect that. It doesn't show that you have an outstanding line because it's for your business. However, you are signing a document saying that, I will provide unlimited amount of guarantee and, we'll make sure that you're made whole.
Great. So Sharon's group in the panel before this one, they talked a lot about cost of capital. We've seen interest rates rising over the last couple of years. And so I just want to get a sense of, how has that increase in the cost of capital impacted, how a business might seek financing or might search out financing?
Yeah.
And do you see that rise in interest rates as more prohibitive, or are there other things that business owners have to be aware of and deal with that might even be, more substantial, like healthcare costs and things like that?
Yeah, no, I think it's a great question. Certainly, higher interest rates impact, your ability to borrow or make those monthly payments. So yes, it has that with it. But oftentimes when you look at it, again, sources of capital, you can give up equity by bringing in partners or investors, and the way they would come in, they will provide you the funding. In return, they will, ask for 25% of your company, right? So depending on how well your company does, in some cases, that may be beneficial. In other cases, oftentimes it is not. Because for a loan or a line of credit, the expense that you're paying for is potentially an annual fee. Some lines don't have an annual fee, smaller lines, but some do. And then interest expense that you're paying on the amount of the line of credit that you're using for the time period that you're using it, right? So if you don't use it, there's no expense associated with it. It's just the annual fee that you pay for it, right? And I think of that as sort of an insurance policy. Let's say you establish a $500,000 line of credit, and for that you pay, let's say, $1,500 fee annually, or a $1,000 fee annually. It is similar to having an insurance. You want to have it in place with the hope that you will never need to use it. But if you really need to use it, it's worth every dollar that you're paying for that fee on an annual basis, right? Having access to $500,000 for paying only $1,000, that's fantastic, right? So that's one way to look at it, right? And the interest rate, yes, again, the higher rate environment that we're in today, it impacts your bottom line. So as you're going into, bidding on a contract, think about that, right? Like which type of, pricing model is more favorable to you, right? And focus on that because, depending on your company's strategy, also, sometimes you may be looking to grow the top line. Growing top line is fantastic because it means that, ultimately you're going to make more money if you can keep the margins, right? But sometimes that maybe is not the best strategy to continue to grow the top line, right? Focus on your profitability, right? So all of that impacts it. I'll give you a quick example. So let's say you have a company that does X amount of revenue, I don't know, $1 million revenue. At the end of the year, you make $20,000 net income after you pay yourself and pay everybody else, just $20,000 in net income. If you're paying interest on a line of credit at, let's say, 5% or 10%, calculate that over 20,000. It could be around $4,000 to $5,000 max, right? That's your interest expense that you're paying on that line of credit, including the fee, right? That's a relatively lower interest rate, let's say prime, 8.5% today. If you have given equity up, let's say 25% of the equity you gave to somebody else. Now the $20,000 that you made, immediately $5,000 of that income that you have made at the end of the year, that goes to that equity partner because they're a 25% owner. So now you're left with the $15,000 that you're dealing with, right? So make that comparison, right? Does it make sense to give up equity? If you're expecting your company to perform well and be very profitable, imagine if that net income was $100,000. Now you have given up $25,000 to that equity partner, right? Whereas your interest expense could be $6,000 annually. So then the line of credit all of a sudden, despite the higher interest rate, is a much, much better option versus giving up equity. So it really depends on your business type and your growth trajectory and projection. So you have to be very honest about it. But oftentimes it's easier to secure a line versus giving up equity and getting an equity firm to invest. Matt, your thoughts on that?
So generally, if you have receivables, you should always have a way to finance a receivable to pay someone, even if you never use it. Because what will happen is you'll come up with, I have receivables, and this could be, I have a line, but it's maxed out, like your example earlier, or you don't have a financing facility, but you have a receivables, you should have a way to finance it. That's one. The second thing is, it is rare that I see someone pay so much money for financing that they don't make money. Like you have to be getting merchant cash advance loans on the internet from the loan shark in New Jersey to not make money. And here's my example. A lot of people have a piece of paper and a pen. You have a company A, their APR on their financing is 6%, and their margins are 8%. All right, everyone got company A? Company B, their APR is 12%, and their margins are 10%, okay? Who makes more money? Company A, APR 6%, margins 8. Company B, APR 12, margins 10. Who makes more money? Who wants to run company A? Who wants to run company B? Who's confused? Company B makes way more money. Why is that? Margin and APR in different time scales, right? The 12% is only 1% a month. The 10% margin comes in every month. It gets back to Mustafa's point. You got to understand your margin. The cost of capital, unless you're paying 40% APR or something ridiculous like that, the cost of capital, if your margins are correct, is almost irrelevant, right? Now let's look at real drivers of cost in businesses. Healthcare cost. Like those really drive your cost. Like on a $100,000 invoice, at 6% APR, you pay about $500 a month, right? At 8.5%, or if you just take that to 9%, you're only going to pay like an extra $250 a month. If that is your break even, that increased in the cost of financing, then you're not making any money to begin with anyway. Like you're barely making money at all. So really focus on the margin that you're getting on your contract. The most important thing is, do you have certainty of access to capital to spin your operating cycles if you have appropriate margin?
Percentage of the businesses you work with that are startups, super early stage, 0 to 4 million, 2 million?
A third.
Well, and what percentage pursue of those focus on firm fixed price contracts?
So the question is basically of the smaller businesses who focus on firm fixed price contracts to others. So there's 3 types of contracts, right? Cost plus, T&M, FFP, right? All right. So in firm fixed price, who takes on the risk of profitability? Contractor. Who can make the most money? Contractor, right? A lot of small businesses do firm fixed price, right? T&M, the cost is generally on the, risk is on the customer, right? And then you have cost plus contracts. Of the 3 contracts, which ones are the margins the smallest? By far, it's not even close, if you bid correctly. Cost plus, because what's your margin in cost plus? It's like 8% less your interest cost, right? Every time, repeat, rinse, recycle, no matter how big your revenue is, no matter what it is, no matter what, right? That's what it's going to be, right? So a lot of small businesses that get started, if you're a sub to a big guy, you're usually T&M, right? It's a T&M contract, and then, if you're prime, you can see T&M or FFP. I will say we've seen a lot of firms that get started and they're sub to a prime, where you have to be really good on your cash flow. You're billing T&M, but you're paying FFP to expensive employees, right? And like all of my clients that are in that boat, their favorite month of the year it's coming up, we're super close. Favorite month of the year is March. Why is March the best month of the year? 23 billable days, no federal holidays. I mean, right? Because I'm paying the same amount to folks, but I know folks should work a lot more. So, does that answer your question? Yeah.
So any idea what percentage of small businesses?
I would say most small businesses start in T&M because they're subs. Are you talking services or product?
Yeah.
I'd say almost all subs are T&M. And then once you get the prime land, I'd say in the small business world, you don't typically have cost plus contracts. You typically have, I'd say it's 50-50 FFP to T&M.
I would imagine it's the same for us. I don't have data points, but probably somewhere along the same lines, because it depends on, if you're a smaller contractor getting started, you're generally a subcontractor, and that's where you will fall, whether, you're a 8A or something, other certifications you may have through which you'll get those contracts.
So, talking about contracts and what does it look like, or can you talk about specific instances where, you had a client that was bringing on additional contracts and you were able to maybe do a little more for them, or another scenario where maybe they lost a recompete or something happened there? How does the status of their contract mix impact, your strategy and how you go to market?
From a banker's perspective and the way banks look at these things, and JPMorgan Chase specifically in this market, we do have a government contracting program specifically designed for small, government contractors. I've been in the business for a couple of years, have had a few contracts, not a lot. What happens is, if you're a small business, that 1 to 10 million space, 1 or 2 new contracts could significantly change the dynamics of your accounts receivable, right? You may have 2, 3 contracts, and now you receive the 4th one, which is, size-wise, the same size as your other 3 contracts. So all of a sudden, the concentration risk is tremendous, right? So one of the things or the challenges that we see, and part of the reason why we established this program was that, generally banks, commercial banks, top 10, let's say, also some regional banks, will look at your accounts receivable, and if there's a concentration of 25% or more, they immediately discount that. They say, well, if something happens and you're not performing and you're not collecting on that, there's too much of a risk. So we're not going to consider that as part of your receivables. We're going to look at the rest of it, and we're going to lend about 75 to 80% of the rest of your receivables that you have, right? But we know in this industry, in the government contracting space, again, 1-2 contracts can change dynamics for you. And so we at JPMorgan, we have raised that concentration requirement to 50%, for example. So doubling that, so up to 50%, it still will be considered what we call eligible receivable to collateralize your line of credit, right? And again, different firms, different banks have, different requirements. But again, you want to work with someone who understands the industry and is comfortable with something like that, right? And then also on your prime contracts or subs that work with a major prime, publicly traded company, a Booz Allen of sorts, you can go up to 90% of those receivables, or we will finance up to 90% of those receivables. But yes, if it's your first contract and you don't have a track record and you haven't performed, or if you have lost a contract, especially if it's because of performance, that creates challenges that kind of takes the bank away from the equation, where a bank will not be at that point a good partner, or may not have the capabilities to help you in those situations.
Yeah, the way that we structure, or more, when you get in a non-bank space, you get a little bit highly more structured relationship, so we don't care about the concentration risk. What we do tell folks, if you're going to be rapidly growing, because government contractors are a lot different, especially in the service space, or in product space for that matter, you can do $100,000 a month for 10 straight months, and then the next month do $1 million. You can grow really rapidly, right? So it's always good to have conversations with your banker, or whoever's financing the firm, say, hey, this may happen, and if this happens, can you meet this need? And if they can't meet the need, then that's okay. Who would you recommend me to go to meet this need, right? But always be having those conversations so that you don't, it's the 20th of the month. Hey, Mustafa, I won this contract. We started on it. My payroll's $400,000 more than it was last month. Can you guys increase my line? And that's just short. Like, maybe you can, maybe you can't. So I'll have those conversations if you're going to be ebbing up and ebbing down. The last bit, I'll double down on a caution that Mustafa mentioned earlier. If your contracts are dipping or your revenue is dipping, it's really important that your line of credit at a bank or whoever, you're on a revolving facility. When you're building your cap stack as a business owner, you can make decisions early on that will sink your ship or prevent you from sinking your ship. And here's what I mean by that. Your capital stack should be like a buoy on the water. Tide is up, buoy's up, right? Revenue up, can borrow more. Revenue down, you can borrow less, right? No matter what happens to the tide, that buoy is always on the water. That's what you want your financing to be. It can be very dangerous if you get a term product early on as a company. That's like an anchor. If the revenue drops and you got that term product, and structurally the reason why is, and you're very more technical about it than I am, you want your asset class to match your liability class. So if you have assets of AR, you want current liabilities of like a line of credit or receivables financing. If you own a long-term asset, like a tractor, then you could get a term loan to buy the tractor. But as long as you're matching up, everyone's seen on your balance sheet, long-term asset, long-term liability, current liability, as long as those two things always match up, you're really protecting yourself from a down cycle. And you're giving yourself the ability to grow in an up cycle.
Yeah, and we kind of hear a little bit about resistance to debt, or that debt maybe can't be used effectively. But Matt, can you tell us about a time where you were able to work with a client and help them use that to fuel growth exponentially?
So exponential growth can be a lot of different things, a lot of people. 2 quick case studies. I had 2 guys in Mississippi that reached out to me 3 years ago, and they started with a small $500,000 facility. They're a product reseller, both veterans. And now they have a $2 million facility, and they resell jet fuel and cars to the government. And I think last year they did like $16 million a year. It's like unbelievable in like 2 years of growth. On the services space, last year, I had a group go from 1 to 24 employees in a month. And we funded the payroll and then the receivable, and they rock and rolled. You know, when you're growing exponentially, the thing that you have to remember as a business owner, don't get caught up again with cost of capital. It's important, but not as important as you think it is we all fund the outputs of everything else in your system as a business, right? So if you can't keep time well, it's hard for me to lend you money pre-receivable, right? If you can't generate a receivable quickly, it's hard to finance your receivable. If you can't get the bills from your subs to turn it into the receivable to the government, then that slows down your ability to generate a receivable. And that would affect my ability to finance receivable and probably impact how quickly that can go in the borrowing base that you use with the bank, right? So we fund the outputs of successful back office functionality. And if that is not operating well, growing quickly from a capital perspective, in my opinion, and for what I do from the chair I sit in, it's really easy. But like, if the financials don't make sense, and if your receivables, I just looked this the other day, the receivables aging had a bunch of receivables from 60 to 90 days out aged, which if you're familiar with government contracting, that should be weird, right? Like everyone pays in under 60 days. So it's like, hey, why do you have all these receivables that are between 61 and 90 days? They're like, well, some of those have been paid, but we haven't cleared them out. And then those other ones there, like they got kicked out for this thing. And it's like, you can't bill properly. Like, that's a yellow flag for everybody, right? So if you're going to grow quickly, get the back office in order or have people that you can put into play to make sure that the outputs of those functions make our jobs a lot easier.
I think you said it very well. So quality of financial statements, quality of your operations. You know, you said yellow flag, I would call it red flag for banks, right? So if we see financial statements that, you know, have questionable items on there, accounts that should have been closed in the prior year that didn't, or you have receivables that are outstanding because you can't get your billing act together, that's going to be questionable, right? We're going to say, okay, do you have really the capacity to run your business, right? It's one of the C's of credit as well for the banking credit geeks. So character and capacity, those are, you know, very, very important to C's of credit.
So what's a good example of your firm kind of creating something maybe a little bit outside the box for a newer business that really kind of helped position them for success?
So on the services space, I will admit that because I think that's pretty easy. You have payroll, fund payroll, you move on down the road. The product space is a totally different animal because you have to buy the product from somebody else. And so we had a guy who was reselling, what was he selling? It was some esoteric item. But anyway, he was reselling something. It was a couple years ago. And I gave him a letter of financial capability for $5 million. And because of that, the manufacturer gave him net 10, which was huge because that meant the manufacturer could ship the product, give our guy the time to create a receivable, then we finance the receivable and he goes and he paid the manufacturer. He didn't need any pre-receivable financing. So it reduced his need for capital by about 30 days. So we told him, like, hey, here's a letter of financial capability for $5 million, plug in the solicitation number, and you show it to the manufacturer, and you tell him, hey, once I bill, I'll be able to finance the receivable and pay you. And he used that to probably save himself, you know, $25,000, $30,000 of financing costs. It's a pretty sizable order. So, but there's a lot of tools in the product space. There's a lot of interesting levers that you can play. On Mustafa's point, he brought it up. It's the cash conversion cycle, right? It's like, why is Costco's model the best model ever, right? Because we all go buy the large jar of mayonnaise with a credit card. They get paid on like day 3, and they have net 30 terms with their suppliers. Their cash conversion cycle is negative. So any, you know, jiggering on that, you can save yourself quite a bit of bucks.
Well, it goes back to time, right? Like you talk about, you're basically buying time, and that gives you a lot of options.
Yeah. So, you mentioned the word what creative things would you do? Banks generally don't like to be too creative, okay? We are very heavily regulated. We want to play by the rules that are, you know, given to us. But within that, you know, knowing and understanding, you know, what different types of credit vehicles are available to you is extremely important. So when it comes to startups, right, generally we rely on SBA guarantee, right? So that is something that's not talked about a lot in the GovCon space. But through SBA, we can also offer lines of credit, revolving lines of credit. They have an express program that we can rely on. And then what SBA does is, obviously, SBA doesn't lend money, right? Banks lend the money. Government says, Small Business Administration, that, hey, if you check all these boxes, right? If your underwriting standards meets that of ours or exceeds that, even better, and you are taking all the, measures, you're taking the collateral that's available to you, and the requester of the credit, your customer, meets your credit underwriting requirements, we would be happy to guarantee up to 75% of the money that you're giving to them, right? So in cases where there's collateral shortage, right, you don't have a contract, in place, you're just getting started, but you have projections. We had a great example of one of these clients in Richmond, Virginia, where a gentleman named Michael Green operates. And he was able to provide some funding to a company that was experiencing exponential growth. And for them, it was specifically related to a product that they had created. And I'm going to provide you a lot of details. It was basically a software. They had to make a lot of investments to complete the development of this software for a government agency. They had to make an investment of $500,000 in hiring a couple engineers, certain hours that they had to bill, and some equipment as well. So for that, it was a term loan situation in this case. They were not going to see the return on that immediately. So we, established a line of, first attempted to establish a line of credit, ultimately ended up with a term loan, SBA 7(a) term loan, 10-year fixed, repayment. This was a company that also had a couple other, contracts. So they already had a revolving line established, but now they were looking to, invest some capital into one particular project, right? So SBA came into play, and, you have to look around and see which one of the banks that you're working with, or if you're not, look at the banks that are preferred lenders by SBA, right? We have to meet certain requirements that SBA has. JPMorgan Chase is a preferred lender, and it means a couple things. That first, our underwriting standards meets the requirements, and then secondly, we have performed time and again, right? So the way we underwrite and the track record that we have established is one that SBA is very happy about, and that also helps reduce the process, because oftentimes borrowers will be like, SBA has a lot of paperwork. Well, if we're able to do all things in-house and not have to ship your file to SBA for approval, that cuts into that, right? It saves you a lot of time and money as well. So that is an option. So if I were to talk about something creative, from time to time, SBA guaranteed loans, different programs available there, could be something that you can call creative.
Great.
So I just want to take a step back for a second. So you already have a line of credit to the bank, but you haven't received your first contract yet. You received your first contract, but now you need more than what your line of credit is. Are you recommending that you continue to finance your business, or come back to your banker and see if that line of credit can be increased? It's going to take 45 days to the government pay you.
Yeah, so that would be an interesting scenario. If you have a line of credit established before you even get a contract, right? That line was established based on something else, right? Based on your personal credit, maybe other revenues that you generated through other, avenues that your business operates and generates revenues, right? Typically, that would be a scenario that you want to have a conversation with your banker and say, hey, even before you're awarded that contract, that I'm bidding on such and such contract, what do you think my options would be if I win this? I need to increase the line of credit, or I need X amount of capital to be able to, successfully perform on that contract. So having a conversation goes a long way. In our industry, in banking world, I don't want to make it sound too complicated. It's really not. But at the same time, it's like anything else. If you look at the, healthcare space, you may go to your doctor because you're coughing for the last 7 days and you don't know the reason for it. You think you have a common cold, but you go in there. They have to do their analysis. They have to find out exactly what's contributing to that before they prescribe, any medication, right? And in the banking world, it's not much different, right? The capital need, yes, there are several reasons why you would need to have access to capital, but for each company, in each company's life cycle, it's very specific. So without getting into the weeds of all of that, having that conversation will help you understand, what would be the best way to go. Yes, ma'am.
Oh, wait, since we're on Zoom, you have to use the mic, sorry. I know you guys don't like to use the mic, but.
So, excuse me, kind of hoarse. So if you look trying to bid on a contract and they require that you have so much capital to even win the contract, then do you guys invest in those type of situations?
We do those letters of financial capability all the time.
Thanks. Just to follow up on that a little bit. What's the timeline on getting one of those letters? I forgot the term of art, sorry, but how long
So I
does it
tell
take?
people like 1 to 2 business days, just because like I may not be in the office to get it done. Yeah, I mean, to be clear, it checks the box. It's not a commitment. Still have to underwrite it. The only time they won't give a letter if you're using like a really expensive like internet lender. We know that we can't work with that cap stack. If you're with a bank, we'll always give the letter. If you don't have financing, we'll give the letter, but it's a non-committed letter. But I just tell people, you don't know my schedule, so if you send me an email and I'm at a conference all day, then if you need it tomorrow, you're 50-50 if I get to my computer before 5. So, anyway.
So that's an interesting, question about, it's more about capacity, right, for bidding on that contract necessarily than having that money sitting in the bank, right? So there are options if you can successfully bid the contract, you have then the capacity. It's almost like chicken and egg, right?
Yeah,
So,
a little bit. I mean, you have to remember, like, pretend you're a contracting officer. I have Jimmy's IT company in General Dynamics, right? Or whoever, a big company. If everyone doesn't perform on the contract, if I chose Jimmy's company, it's like, whoa, why'd you choose Jimmy's company, right? But if you chose a big company, it's like, well, if they couldn't perform, then maybe this job was impossible, right? So everything is a risk aversion, right? How can I de-risk the awardee of this contract? If you have a letter and you went through the process of I reached out, I found someone, they know the FAR, they gave me the letter for this amount, at least you've gone through the steps of the mental exercise of getting the letter. So maybe you're a less risky, and you've checked that box, you've cleared that hurdle, you've done those things that if awarded, could get it, could find it, could be approved. It's less. And I kind of, there was a friend of mine, he was a former contracting officer, now runs a consulting shop. And we do the assignment of claims. And I asked him, what's your view on assignment of claims? Because that's something that's filed with the government. And he's like, I love assignment of claims. I'm like, I've never heard that answer before. Why? And he goes, because I know you have financing in place and I can take that worry off my list. Like, I worry that you may not have financing. So that's where he's gone. So it's all about the de-risking component. Like, have you gone through the steps? What they don't want is you're awarded a 50-person contract and then you go, oh, wow, we got it. And then we start our search for capital. Hey, Mustafa, you give me some money? They don't want that. They kind of want you to think around the corner. That's my view of it. Never won a government contract, not a procurement expert, but it just seems they want you to go through the process.
Yeah, it's like, another completely different type of example would be you go to a job interview, right? How you prepare for that job interview. Do you have a business plan that you've put together? Is it aesthetically pleasing when the interviewer looks at it? Does it have any substance? And if it doesn't, at least does it look nice, right? So have you done any work to show that you have the capacity, right? Have you done the basics that you can do and check some boxes? And getting that letter, to Matt's point, it's not a commitment letter. We don't issue that, by the way. We can do it in 2 days, but we don't generally would issue that, and that's why we have partners like Matt who will come into play in situations like that. But if you have an established company, oftentimes, yes, it's recommended to establish a line of credit when you don't need it, because when you actually need it, you may not be in a good situation to do that. So there's absolutely value in having a bidding line of credit in place.
what role do special certifications play in the process at all? Like, if, working with 8As or working with service disabled, how do those kind of come into play when talking to a lender?
The nature of our client base, I think about half are SDVOSBs or VOSBs. We work with a lot of set-asides. That being said, it has zero bearing. I mean, if you have quality receivables, we're in the business of financing receivables.
Yeah, for us, I would say yes. Vast majority of our clients also in that smaller space have some sort of certification. And it's important because at least you have certain set-asides that you qualify for, because when you're starting out, it's very hard for you to compete in the out and open environment, right? You're coming across some major primes that you may not be able to compete with. But they will hire you as a sub, right? You will go in with them as a sub. And so those certifications, we do look at those favorably, 8A, but also how far along are you in it? Are you, in the first couple of years, or are you about to graduate and all your contracts are 8A, right? And you don't have anything else. And so then the question will be like, okay, well, once this expires or, you don't any longer have the 8A, are you able to continue to exist as a business? Have you secured any other contracts? And so that comes into play as well.
Great. We're getting a little close to time, but does anybody in the audience have any other questions or things that have come up in your experiences with banks that we can demystify?
Yep.
No?
Nope.
Okay. Gentlemen, any final words of wisdom for our attendees and for government contractors in general?
I would say the biggest thing, I don't think it's complicated, like Mustafa said. Make it a relationship conversation with whoever you're using for financing. Let them know what's happening around the corner. Finance is third grade math with nomenclature. It's not tough. There's no magic person in the box making a decision. It's a very simple process. But just make it a conversation. Now allow yourself to plan so that you can make relaxed. I always tell folks that we want to walk across the finish line, not run across it. It's not very good for my health to run across the financing finish line. So just look around the corner and make it a conversation with whoever you're working with.
Yeah, building those trusted relationships early on, especially. Talking to a banker who is willing to listen to you and gets to understand you and your business, your goals, is more important than anything else, because when things are going great, any bank can open a checking, saving account and offer you a line of credit in most cases. But it's those times when you're struggling, you need to have someone who really takes the time and invests that time to get to understand you and work with you as a partner. Just like a lawyer, an accountant, again, I mentioned that earlier, have a board of advisors, and one of those should be someone from the banking world. That's it.
Great. Well, Mustafa, Matt, thank you guys both for the words of wisdom and the information. I hope all the attendees found this valuable. We'll certainly be around, if you continue to have questions. We certainly appreciate it. And many thanks to the NVSBC for putting this event on and having us join. So thank you so much.
Thank you.
Thank you. Thank you.